Well, what's happening now is the Federal Reserve has had all of these really extraordinary programs going. They've locked down the short end of the interest rate curve, which they control directly. They set the bottom rate that all the short rates, the floating rates, are indexed off of. On the long end of the curve, it's harder for them to exert control. Their toolbox is not as deep. So what they've been doing is utilizing what's called quantitative easing. If you think of it like a farmland auction, they're showing up. They're the, guy from the city that's maybe represents a pension fund, doesn't have the same economic considerations that the other buyers at the auction have. So they're coming in that auction with a mandate to purchase X number of bonds, acres in this analogy, regardless of the price. So as they purchase more and more and more, it obviously has an impact on the rate of interest that you have to pay to sell those bonds. So it has the effect of driving up the bond market, which drives down the interest rates. As the Federal Reserve exits, they're going to start lessening these purchases on the long end. The long end of the curve is going to come up. Farm credits rates are going to come up on the long end, and they'll continue to have the short end anchored. So if you have that debt out there from purchasing farmland, and you are going to have that debt around on your balance sheet for a long time, the longer you wait, the less of an opportunity you're going to have, and it has the potential to trap you on the short end of the curve, because you're going to keep floating with your interest rate to maintain a low expense on that interest. Meanwhile, your options to fix and lock it in are going to continue to get worse. Then when they're done easing their purchases, when they're not buying anymore, then they're going to start to move the short-term interest rates up. They've said they're going to begin slowing their rate of purchases this year with the goal of stopping purchases sometime during 2014. You probably already have a very good relationship with your local farm credit loan officer. I would just share your concerns about interest rates and have the conversation about what tools do you have that can help me manage my interest rate expense. Look at that balance sheet. How much of that debt are you going to have around in 10, 15, 20 years? That's the part of your debt that I think you should really strongly consider discussing with that loan officer from Farm Credit whether or not you fix and for how long you fix it.